Hi, this is Roger Nussbaum. Welcome to the Big Picture for the week of December 17th. Special party edition. We're having a party tonight. My wife's getting ready for it, and I've got to go join her in a minute. So this will be short, I think. You can decide for yourself whether it's short and sweet. There you go. Two things on the agenda. One is covered calls, and the other is passing along a website that a reader left that is pretty interesting. First, the website, reader Tom K., regular contributor with comments, found a website with some pretty good stuff. It's www.gummy-stuff.org. Check it out. The guy's done some interesting things with some spreadsheets, looking at correlations and just a whole slew of data and information that is probably worth looking at. Moving on to covered calls, I get a free subscription to the realmoney.com, which is probably not a shock to anybody, and get an email twice a day with what the stories are or whatever. And one of them was a video segment on the Street.com TV, Income via Options. Authors Joseph Hooper and Aaron Zalewski discussed their new book, Covered Calls and Leaps, A Wealth Option, with the Street.com's Greg Greenberg. Basically, this is one of those generate 3 to 4% a month on your portfolio by selling call options. Every time I hear this type of thing, and it comes up every now and then, I cringe and I shudder. You're not going to get that kind of average monthly premium unless you go way out on the risk scale. I brought up 3 different stocks here to kind of illustrate the point that I think are a different magnitude of stocks, all in the healthcare, vaguely speaking, the healthcare sector. So the first one is Pfizer. And let me just say that in this interview, they talked about the fact that they sell options that are a little bit in the money. So I found 3 examples where they'd be selling options that are a little bit in the money. So first is Pfizer. It closed at $25.64. If they had executed a trade for a January 25 call option at the close, they would have sold it for $1. When you subtract the 64 cents that it's in the money, you're taking a premium of 36 cents, so it's maybe 1.5% or something like that. Okay? 1.5%, not 3 or 4. If you look at Genentech, closed at, looks like $80.79. The Jan 80 closed at $3. So when you take out how much it's in the money by, or $3 was the bid, when you take out how much it's in the money by, you're left with $2.21. It's a little under 3% by my counting. Maybe it's like 2 3/4%, but it's Genentech. This is hardly a meek wallflower, and even with that, you're already not getting the 3 to 4% that these guys are talking about. The last name I thought to look up was Human Genome Science, HGSI. And by the way, these are stocks that I don't have any position in unless some of them are held in a biotech ETF or healthcare ETF, but I don't own these stocks outright for any clients. Human Genome closed at $12.68. A Jan 1250 at the close was bid at 70 cents. So if you take out the 18 cents that it's in the money, you're left with 52 cents, and lo and behold, you're a little above 4%. So for their strategy to work with, and this is their number, 3 to 4% every month, you have to go out on the risk scale to Human Genome Science, which, if you're keeping track at home, has a beta of over 3, according to Yahoo Finance. So if you've got a portfolio full of, hot potatoes like this, trying to capture your 3 or 4%, the likelihood that it's going to end very badly at some point is quite high. This is, a disaster, I think, a disaster waiting to happen. If you want to sell call options here and there, by all means go for it. I think realistically, you could add another 2 or 3% in a flat-ish market. You could be better off by 2 to 3% a year without too much effort. I've done kind of workups like this on the blog in the past. Maybe it's a good idea to do another one. But the context is increasing the dividend yield, effectively speaking. Obviously, you're selling options, so it's not a dividend yield. From that standpoint, you probably could do well selling options here and there selectively. But this, where you're relying on getting 3 or 4% a month or thinking that you can do that consistently, not going to work. Can't stress that enough. If you have a diversified portfolio, you've got a couple of stocks that are like Human Genome in that they're that volatile. If you've got a 500, 1,000 share position and you sell 3 or 4 call options against it, well, that's pretty good. You bring in a little bit of premium. You're letting plenty of the position run if something great happens. But this kind of totally capping the upside, to me, makes no sense. But that's just my 2 cents. Maybe this will get a little bit of chatter going on the website. I'll try and do up a mock thing during the week, kind of illustrate this a little bit more. But that's about it for now. Hope you all have a good weekend. We'll talk to you later.
Happy birthday, Bill.
Okay, well, that was Mrs. Random Roger, and Bill is who the party is for.